This was the week investors asked, how much spending on artificial intelligence is too high? For Meta, the answer seems to be that no number is too high, as long as the revenue keeps flowing. The company announced a plan to potentially double its capital spending, yet the stock soared. So why did the market reward Meta for its massive AI bet, while punishing a rival like Microsoft for doing the same? It's a tale of two tech giants, and it reveals everything about what the market will tolerate in 2026. Welcome to TickerWatch News for Meta, Week 5, 2026. This week was all about earnings, AI ambition, and the billions of dollars being spent to build the future. We'll break down the company's blockbuster fourth-quarter results, its monumental spending plans, and the legal headwinds that are quietly gathering steam. It was a very positive week for Meta shares, which jumped more than 10% following its earnings report on Wednesday. The surge pushed the stock to 2026 highs and into what some technical analysts call overbought territory. This move came in sharp contrast to others in the tech sector. Microsoft, for instance, saw its stock slump around 10% after its own report, as concerns over its cloud business growth weighed on investors. The broader Nasdaq index fell during the session, showing that Meta's strong performance was a standout in a mixed market. The biggest story was Meta's fourth-quarter 2025 earnings report. The company beat Wall Street estimates on both the top and bottom lines, reporting revenue of nearly $60 billion, a 24% increase year-over-year. Earnings per share came in at $8.88. The social media giant's advertising business was the main engine, with revenue jumping 24% to over $58 billion. The growth was fueled by an 18% increase in ad impressions and a 6% rise in the average price per ad, suggesting strong advertiser demand during the holiday season. That strong performance is funding a colossal bet on AI. Meta announced it expects to spend between $115 and $135 billion in capital expenditures in 2026, a figure that could nearly double its $72 billion spend in 2025. CEO Zuckerberg called it a major AI acceleration in pursuit of personal superintelligence. The spending is focused on infrastructure, including a new $6 billion deal with Corning for fiber optic cables to support its U.S. data center expansion. Despite the huge price tag, Meta also issued a strong revenue forecast for the first quarter, projecting sales well above analyst expectations. It wasn't all good news, however. The company is facing significant legal challenges. A child safety lawsuit filed by the New Mexico Attorney General is set to go to a jury trial. The suit alleges Meta didn't do enough to prevent child exploitation on Facebook and Instagram. This will be the first time such claims are tested before a jury. In a separate matter, Solos Technology Limited filed a patent infringement lawsuit against Meta and its partners over smart glasses technology, targeting features and platform architecture in Meta's wearable devices. Finally, the company's AI strategy is becoming clearer. Beyond ad ranking improvements, Zuckerberg detailed a vision where AI agents understand users' personal context to tailor content and even create new immersive media formats. He sees AI-powered smart glasses as the successor to the smartphone, noting that sales of Meta's glasses tripled last year. The company is also bringing AI features to its business tools, with AI-powered chatbots on WhatsApp and click-to-message ad revenue growing. However, the Reality Labs division, responsible for these futuristic bets, continued to lose money, posting a loss of over $6 billion in the fourth quarter. The market reaction to Meta's report was overwhelmingly bullish. The stock's 10% surge showed that investors are willing to fund the company's aggressive AI spending, as long as the core advertising business demonstrates strong growth. The narrative on Wall Street is that Meta is proving its AI investments are paying off right now through revenue acceleration, a contrast to Microsoft, whose stock fell on concerns about slowing cloud growth and the immediate return on its own AI investments. Analysts were quick to praise the results. Truist raised its price target on the stock to $900. Bank of America followed, lifting its target to $885, citing that AI is driving returns for Meta more than its peers. Jefferies set a price target of $910, and Rothschild upgraded the stock to a buy rating, encouraging investors to buy on any weakness. The consensus rating on Meta shares is a strong buy, with analysts highlighting the company's robust ad demand and long-term platform dominance. From a technical perspective, the stock's powerful post-earnings rally pushed its 14-day Relative Strength Index, or RSI, to 73. A reading above 70 is typically considered to be in overbought territory, which can sometimes signal a short-term pullback is possible. Shares are now trading near their 52-week highs. On the fundamental side, Meta's valuation presents an interesting picture. Despite its massive size and recent run-up, the stock trades at a forward price-to-earnings ratio of around 22. That's a discount compared to other members of the Magnificent Seven, even though Meta is posting faster revenue growth. The company's return on invested capital is a healthy 27%. However, the Reality Labs division remains a significant drag on profitability, with operating losses for the unit reaching over $19 billion for the full year 2025. What to watch next week? Looking ahead, the key item to monitor is Meta's execution on its expensive AI roadmap. Investors will be watching for the new AI models and products Zuckerberg promised will ship in the coming months. The company's ability to continue growing its ad revenue to fund the $135 billion CapEx plan will be critical. Ongoing legal and regulatory issues remain a significant overhang. The child safety trial in New Mexico and the patent dispute over smart glasses could result in material losses or impact product roadmaps. The company itself has noted it has a number of trials scheduled in the U.S. this year. Continued scrutiny from regulators in both the U.S. and in Europe is a persistent risk factor. To sum up the week for Meta, the company delivered a powerful fourth-quarter earnings report, with revenue and profit beating expectations, driven by a resurgent advertising business. Meta is making an enormous bet on AI, forecasting up to $135 billion in capital expenditures for 2026 to build out its infrastructure. Investors cheered the news, sending the stock soaring, signaling confidence that AI investments are already fueling revenue growth. But significant risks remain, including mounting losses in the Reality Labs division and major legal battles over child safety and patent infringement. The coming year will be a test of whether Meta can deliver on its grand personal superintelligence vision while navigating these substantial headwinds. Thank you for tuning in to TickerWatch. This podcast is for educational purposes only and does not constitute financial advice. We encourage you to do your own research. Be sure to subscribe and leave a review to help others find the show. We'll be back next week with more on the companies driving the market.